Welcome to The Deep Dive. Today we're tackling a challenge that's, well, it's genuinely keeping insurance industry leaders awake at night. How do you effectively cover those massive, unpredictable, heavy tail losses?
Yeah.
Think about natural disasters, maybe amplified by climate change, or the constantly evolving, often devastating landscape of cyber risks.
It's huge.
It really makes you wonder, are we, in some key areas, heading towards a future of uninsurability?
It's more than just a wonder, I think. It's becoming a critical reality.
Right.
Traditional insurance models, the ones we all know, they fundamentally struggle with these types of risks. Their potential for destruction is just so extreme that the mathematical expectation of loss, well, it might not even be finitely calculable.
Wow.
And this results in significant protection gaps. Vast areas where effective coverage is either impossible to price, or it's prohibitively expensive, or, frankly, it just isn't offered.
And for you, listening in as a risk manager, that's just not sustainable, is it?
Not at all.
Your businesses, your communities, they need resilience, not these huge gaps. So what's the most promising, maybe cutting-edge solution emerging to tackle these really extreme risks?
Well, that's where we're seeing some really exciting potential. It's about combining traditional insurance with a more modern, agile approach, parametric insurance.
Parametric, okay.
And today, our mission in this deep dive is to explore a brand new, innovative calibration method for this kind of hybrid model. We're pulling insights directly from the latest research here.
So fresh off the press, basically.
Exactly. This isn't just theory. It's meant to be a practical, crucial deep dive. We want to offer you a shortcut to understanding how these products can be optimized and, applied to navigate some of your most complex challenges.
Okay, let's unpack this. First things first, let's define the beast we're trying to tame here.
Right.
What exactly do we mean by heavy tail losses in the context of insurance? For those of us maybe not wearing our statistician hat right now, what's the picture? Is it like a really steep cliff or?
That's a good way to think about it. Yeah. Picture it less like a normal bell curve, where most things cluster around the average.
Yeah, the familiar hump.
Right. Think more like a distribution with a very long, very fat tail. So even though the probability does decrease as you go further out into the extremes,
It doesn't drop off fast enough.
exactly, it doesn't decrease fast enough. So those once in 100 years events aren't just rare. They're potentially much, much larger than typical models might predict. These are losses whose distributions are technically called Pareto type. And that implies a surprisingly high probability of extremely large catastrophic events happening.
And that sheer unpredictability, especially of the biggest losses, that's precisely what makes traditional full coverage models so difficult, isn't it?
It is.
I mean, imagine a single massive tornado hitting a populated area, or maybe a widespread cyber attack crippling infrastructure across multiple sectors.
Yeah, the systemic ones.
Exactly. These events, when they do happen, can be just astronomically expensive. It makes traditional full coverage insurance really difficult, maybe impossible, or just so expensive nobody can afford it.
And it gets even more challenging when you bring in the concept of infinite expectation in some of these scenarios.
Okay, that sounds pretty daunting. Infinite expectation.
Yeah. When a loss distribution is truly heavy-tailed, the mathematical expectation of that loss can, theoretically, be infinite.
Right.
Which sounds terrifying from an insurance perspective, doesn't it?
It absolutely does. How does that break standard risk pricing? Yeah. Because that relies on calculating averages, right?
It breaks it precisely because standard pricing starts by estimating the average or expected loss. If that average is infinite, well, then any premium you charge is, by definition, insufficient.
It's like trying to price something that just keeps getting bigger.
Exactly. Like trying to put a price tag on something with an endlessly expanding value. You clearly need a completely different framework.
Which is why this research is so important. And it sounds like this could really be a fundamental shift for these extreme risks. So, parametric insurance. At its core, how does it truly differ from what we traditionally think of as insurance?
Okay, so with parametric, the compensation, the payout, it isn't tied to the actual audited loss, the process that can take ages after a catastrophe.
Right, the claims adjustment nightmare.
Yeah. Instead, it's tied to a predefined observable parameter or index.
Like what? Give us an example.
Think of, say, a specific wind speed measured at a certain location, or an earthquake magnitude hitting a certain Richter scale value, or even a particular temperature threshold being breached.
Okay.
If that parameter hits a pre-agreed level, bang, you get paid. Essentially, that's straightforward.
And that simplicity, I imagine, brings a whole cascade of advantages for insurers and policyholders.
Absolutely. First off, the costs. They're significantly reduced.
How's
Well, you have lower expertise requirements, lower claim management costs, simply because the compensation is instantly computed based on that index reading, not a lengthy, costly loss assessment process.
that instant computation? That must mean faster payouts, too.
Much faster. And that's crucial for policyholders, for resilience after a catastrophic event.
Yeah, I can see that. Imagine getting funds almost immediately to start rebuilding, instead of waiting months, maybe even years, for an adjuster.
It's not just convenience, like you said. It's crucial for a community's survival, for a business getting back on its feet.
And presumably fewer arguments.
Exactly. The clear, predefined rules mean fewer legal disputes. Everyone knows the triggers up front, so there's just less room for argument or drawn-out litigation.
Okay, so faster, cheaper, clearer. What about the bigger picture for risk managers? You mentioned mobilizing capital earlier.
Right. Parametric insurance also has this potential to facilitate something called insurance-linked securities, or ILS.
ILS, okay.
This basically allows for the transfer of catastrophic risk to the capital markets.
So taking it off the insurer's balance sheet, essentially.
In a way, yes. It mobilizes vast amounts of capital that might not otherwise be available for these huge systemic risks.
Can you just briefly explain how that works? How does ILS bring in more financial firepower? Are we talking things like cat bonds?
Exactly. Catastrophe bonds are a prime example. Investors buy them.
Yeah.
If a specific predefined catastrophic event doesn't happen within a certain period,
They get paid back with interest.
right, they get their principal back plus interest.
Yeah.
But if the event does happen, if the trigger is hit,
The investor's money pays the claims.
the principal is used to pay claims. It's a way for insurers to, well, offload these huge, rare risks onto the broader financial market. It frees up their own capital for more regular operations and diversifies their risk exposure significantly.
Okay, so parametric offers these really compelling benefits. Speed, capital mobilization, clarity. But like any innovation, there's usually a catch, or at least a challenge.
There is.
And for parametric, that challenge often comes down to something called basis risk, doesn't it?
It does. Basis risk is the critical challenge here. It's the potential mismatch between the actual loss the policyholder experiences
They really lost.
and the payout they receive based on the index. The index might trigger, but maybe it doesn't perfectly reflect the damage on the ground for that specific policyholder.
Ah, I see.
So controlling this difference, this gap between the true loss and the compensation is absolutely vital for the product to be effective and, for policyholders to trust it.
Which brings us neatly to the cutting edge part of this research, designing a hybrid contract, using an innovative way to optimize it. So this new research proposes combining traditional insurance, the kind that covers losses up to a certain threshold, let's call it S.
Right, a deductible or a limit.
Exactly. Combining that with parametric insurance, which takes over for the losses above that threshold, S.
So you get kind of the best of both worlds, traditional cover for smaller, more manageable losses, and parametric for the big catastrophic ones.
Precisely. Now, here's where it gets really interesting. According to the paper,
Yep.
for these heavy-tailed losses, they argue you should optimize the ratio of compensation to loss, let's say XY, rather than just the simple difference, X minus Y.
Right. X being compensation, Y being the actual loss. Why the ratio? That sounds quite specific. Why is that more effective, especially with those huge, unpredictable losses?
Well, think about it. The simple difference, X minus Y, it can be completely overwhelmed, just drowned out by those massive, rare events.
Okay.
If your loss is, say, $1 billion, and you get $100 million in compensation, the difference is a whopping $900 million. That huge number might obscure how well the product actually performed relative to the need.
Right. It doesn't tell you much proportionally.
Exactly. But the ratio in that case, 100 million over $1 billion, or 10%, that gives you a much more concrete, understandable indicator of performance. As a policyholder, you want to know what proportion of your loss is covered, not just how many dollars short the compensation was on an enormous loss.
That makes sense. It's a more stable metric when the numbers get really big.
Right. And tied into that optimization is what the researchers call the price aversion function, F.
Price aversion function F. Okay. This sounds like it's trying to address that real-world tension between perfect coverage and what you can actually afford.
That's exactly it.
Is it basically quantifying that trade-off?
Yeah.
Helping find the sweet spot between ideal protection and a premium that doesn't break the bank.
Precisely. It's about modeling how much less coverage a policyholder might realistically accept if it means a tangible reduction in cost. It recognizes that the ideal level of cover isn't always affordable or practical, so it balances that desire for high coverage with the willingness or ability to pay.
Okay, and then there's the choice of another function, L, within the optimization itself. The paper mentions you could use a simple identity function like L1 x.
Yeah, straightforward.
But it highlights the benefits of using something else, L2 equals x, a negative exponential.
Right.
You mentioned earlier it helps with pesky outliers and implicitly models the trade-off between mean and variability. Can you give us a slightly more intuitive feel for that? Is it like, instead of just aiming for the average payout, it's also considering how wild the swings might be, especially at the extremes?
That's a great way to put it. Imagine you're driving. L1 is like trying to keep your speed exactly at 60 miles per hour, just hitting the average.
Okay.
L2 is more like driving at 60, but also having a really smart suspension system and traction control. It accounts for sudden potholes or maybe strong crosswinds, making sure you don't suddenly veer off course when something unexpected happens.
So it builds in robustness.
Exactly. It builds in robustness for the unexpected, which is absolutely crucial when you're dealing with rare, massive events. It stabilizes the whole optimization process. It's much more robust to those extreme outliers. And yeah, it implicitly models that trade-off between the average outcome and how much variability surrounds it. Much more sophisticated than just targeting the mean.
Got it. And of course, the trigger mechanism itself for the parametric part is key.
Crucial.
Ideally, you'd want it to trigger exactly when the actual loss, Y, goes above that threshold, S.
Yeah.
But in the real world, you often don't know why instantly. That takes time to assess.
Right, back to the slow assessment problem.
So the research shows how you can effectively approximate this ideal trigger using those observable covariates, W, the wind speed, the seismic reading, whatever the index is.
Okay.
This is what ensures you still get that fast compensation for the parametric part without needing the extensive, time-consuming loss expertise right away. It's about getting close enough to the ideal trigger without sacrificing the speed advantage.
Okay, this sounds really promising technically. But now let's hit a major practical hurdle. Any risk manager listening knows this pain point well, especially with emerging risks like cyber or in regions with less data.
Data scarcity.
Exactly. The scarcity of comprehensive historical data on both the actual losses Y and the relevant covariates W needed to link them.
It's a huge challenge.
But this is where the research offers a particularly ingenious solution, doesn't it? This two-step optimization procedure.
Yes, and this is a massive practical advantage. Think about it. You might have relatively scarce data on the specific economic losses from certain extreme events.
Right, that loss assessment data is hard to come by sometimes.
But you often have a relative abundance of data just on the covariates at W themselves. Think weather patterns, seismic activity records, maybe network traffic logs for cyber. That data is often much more plentiful.
Okay, so how does the two-step work then?
Right, so in step one, you use the smaller, more limited data set where you do have both Y, the losses, and W, the covariates. It's a richer but smaller data set. From this, you estimate the crucial conditional tail distribution parameters, things like SSW and GODW. These basically capture the statistical links. How likely is a certain loss level given a certain covariate reading?
Okay, so you learn the relationship from the small, good data.
Exactly. Then, in step two, you bring in the big guns. You leverage that much larger data set that contains only W, only the covariate data, which is more abundant. You can then complete the optimization of the hybrid contract using this larger index data set, incorporating the statistical relationships you figured out back in step one.
So what's the payoff? What does this mean for you, the risk manager?
Well, this two-step approach, according to the research, drastically improves convergence rates. You get to the optimal parameters faster and more reliably.
Better accuracy?
Yes, more accurate estimation of those optimal parameters for the contract. It provides a practical, robust methodology for developing these sophisticated insurance models, even when you have limited economic loss data.
That sounds incredibly relevant for addressing protection gaps in developing countries, maybe, where data collection is harder.
Absolutely. Or for brand new, unpredictable risks. Think novel cyber threats, maybe certain climate-related perils where historical loss data just doesn't exist yet.
It makes sophisticated insurance more accessible where it's desperately needed.
Precisely. It's about leveraging the data you do have more effectively.
And the paper doesn't just propose this theoretically, right? They tested it.
They did. They backed it up with real-world validation. They ran empirical analysis using both simulated data to check the maths and actual U.S. tornado loss data from 2016 to 2023.
Okay, real-world losses.
Yes, and these studies empirically confirmed the validity of the proposed methodology. They also show the efficiency gains of the two-step approach, demonstrating that the parameter estimates stabilize and become acceptable even when using about half of the total sample size, thanks to leveraging the covariate data.
That's quite significant, which then raises the million-dollar question for risk managers. How does this fancy new hybrid contract actually stack up against the traditional options in a tangible way?
Right, the competitive angle.
Let's talk about the direct comparison with, say, what we call capped indemnity contracts. That's the traditional way of limiting an insurer's exposure, just putting a ceiling on the total payout.
Exactly, your standard insurance policy with a maximum payout limit.
So how did the hybrid compare?
The finding from this research is pretty compelling. For the same price, for the same premium.
Okay, key comparison point.
The proposed hybrid contract consistently offers better coverage.
Better coverage, meaning?
Meaning a higher expected rate of compensation for the policyholder. You get more bang for your buck, essentially.
Wow. Okay, why? What's the reason for that superior performance at the same price point?
It's largely attributed to those lower operational costs we talked about with index insurance.
Ah, the efficiency savings.
Right. Parametric contracts typically have lower loading factors built into the premium. That's the bit added on top of the pure risk cost to cover expenses, administration, profit margin, etc.
And those loadings are lower because claim management is simpler, faster, needs less expertise?
Exactly. That efficiency translates directly into more of the premium dollar going towards covering the actual risk, meaning more coverage for the same total price.
Yeah.
It makes it a potentially more competitive product to offer in your portfolio.
So the bottom line for you, the risk manager listening in, seems pretty clear then.
I think so. This research offers a concrete, optimized solution. It's not just theoretical. It provides potentially enhanced coverage for those really difficult extreme losses while keeping an eye on affordability. And, crucially, it leverages that faster claims processing, which is so vital for boosting resilience.
Okay, let's wrap this up. In summary, this deep dive has, I hope, shown you a robust and innovative way to structure insurance products for those really daunting, heavy-tailed risks. It seems to offer faster compensation for policyholders when they need it most, reduced operational costs for insurers, and maybe most cleverly, a practical solution for that pervasive problem of data scarcity that so many risk managers face, especially with new or emerging perils.
Definitely hits on some key pain points.
Right. So looking ahead, maybe a provocative thought to leave you with.
Okay.
Given these clear benefits, the efficiency, the speed, how might focusing even more on policyholder preferences beyond just the price tag? Like really valuing that faster compensation for its profound contribution to resilience, to business continuity. How might that perspective further refine and optimize these hybrid contracts in your portfolio?
That's a great question. It shifts the focus from just pure cost benefit to, well, resilience value. How much is that speed worth in a crisis?
Exactly. It's not just about the cost of repair, it's about the speed of recovery. Something to think about regarding the broader implications of these insights for your future product development and ultimately your market competitiveness.
Food for thought indeed.
Until next time, keep diving deep.